All right. Well, good morning, everybody, and thanks for joining the team at SRM today. We're delighted to have you guys back for the third installment in our series on cryptocurrency trends. As you know from our registration process, today's focus will be around recapping 2021 and breaking down why the developments of the past year matter to you. And of course, we'll look ahead to 2022. So my name is Neil Doherty. I'm the VP of Marketing and Communications here at SRM, and I'll be assisting the presenters today during our session. You'll see in Zoom there's a Q&A feature. Please use that to send us questions. It's right next to the chat. So you see chat and then Q&A kind of right next to that. We'll be capturing those questions. We'll try to call them out during the webinar if it makes sense, or at the end of the session today. We're also going to leave time for any additional questions that you might have. So, certainly think of those as we go. And we're recording the webinar, and as always, we'll share it with you and any of our registrants who might have missed the live session today. So we'll make sure that you get a copy of that as a follow-up and email. So now some of those housekeeping items are out of the way. I just wanted to introduce our speakers today. We have three folks with us. First is Larry Pruss, who you will recognize if you joined us previously. Larry is an SVP here at SRM. In addition to uncovering critical savings for our clients in the payment space, he serves as our crypto lead. He's advising clients on strategies to, as we say, turn digital currencies from a threat to an opportunity. So happy to have Larry here today. Also with us is Patti Wubbels. Patti's an SVP of Client Development and collaborates with our other speakers today to provide crypto advisory services, whether that's education, strategic planning, implementation, to banks and credit unions in her territory. And Patti is also a certified cryptocurrency expert through the Blockchain Council. So we're very excited to have Patti join us today. And we also have Keith Ash with us. Keith joined SRM in 2021 after a successful run at MasterCard, where he led new business development for community financial institutions. And Keith is well versed in the regulatory space and payments as well, and is a key contributor to our crypto advisory services team. So really exciting to have all three folks here today. We'll be sharing some insights with you. So without further ado, I'll pass it over to Patti. She's going to get us going today as we recap 2021 and we look to the opportunities ahead in 2022. So Patti, go ahead and take it away.
All right, great. Thank you, Neil. Welcome, everyone. We appreciate your time and interest in joining us today for the webinar dedicated to cryptocurrency. We have a really big group today, so it's very exciting. I am Patti Wubbels. It's a pleasure to kick things off with my crypto partners, Keith and Larry. Unfortunately, my Zoom camera is not working today, so you'll get to see a picture of Neil instead of me. But anyway, we'll get this things going. I'd first like to start with a recent quote from Danny Schulman, who's the president and CEO of PayPal. And he recently said, "The shift to digital forms of currencies is inevitable, bringing with it clear advantages in terms of financial inclusion and access, efficiency, speed, and resilience of the payment system, and the ability for governments to disperse funds to citizens quickly." So as Neil said, today we're going to first review the growing number of case studies and what many financial institutions have recently been rolling out, most recently the end of 2021, and more that we'll see here coming in 2022 in terms of crypto offerings. We'll also talk about the growing public adoption and interest in crypto services. Keith will be stepping us through the emerging payment ecosystem, and both Keith and Larry will touch on updates from a regulatory standpoint. Finally, we'll end up, Larry will bring us home with the areas to consider as your team is thinking about your own potential for going to market with some crypto offerings in the coming year and beyond. So, our crypto team, many of you have seen this or know, this is our current but growing crypto advisory team. We do continue to focus on the intersection between traditional finance and crypto, DeFi, and blockchain development. We have a good understanding of the regulatory environment. We've actually been consulting with NCUA and a few of the others on the regulatory front. The Federal Reserve recently put out an RFI for feedback on the central bank digital currency, or CBDCs. I think Larry's going to talk about that a little bit later. I just want to make sure we've reviewed our crypto team. Before we get too far, though, we do have our disclaimer. You want to, yep, there we go. So just a quick disclaimer, none of us are financial advisors, but we do have lots of opinions. So any information that you've seen here, any ideas, opinions, it's all should be not be construed as an investment advice. As the kids say, DYOR, or do your own research for sure. As well as another disclaimer, the cryptocurrency industry is extremely fast moving. I know we were making edits to some of this information just this morning, but we try to keep you all as up to date as possible, but it is moving very fast. All right, now that that's out of the way, we wanted to start today with one of the biggest questions that we get asked about, and that's how are financial institutions getting involved in cryptocurrency? What are the use cases? So we wanted to start with this and give an update as to what's really catapulted at the end of 2021 and what's really advancing and continuing on into 2022. So for anyone that's joined us on the first couple of webinars that we've had, this slide and the next slide, originally when we used them, they were all on one slide, but because of so many recent announcements of institutions launching their crypto offerings, we really actually had to split this up. It was just getting so busy. So I will say the first mover advantage window continues to get smaller. However, that doesn't mean anyone should be jumping into a solution too quickly. Learning and being efficient in your strategy will set your team up for better success in this space. So for any institution looking to get into digital assets, you need to look at some sort of custodial services first. Digital currency isn't physical, it's electronic, but it does get access to those electronic assets. You have to access those through your digital key. So basically those digital keys are the equivalent of a password, and if one loses their keys, they're out of luck. So financial institutions can offer your customers or your members the ability to hold or custody the digital keys or customers' digital keys. And this is basically the equivalent of holding keys in a safety deposit box. This custodial services can easily be provided by institutions through many third-party vendors. But just to be clear, this does not mean that you're bringing on any digital assets onto your balance sheet. The custodial services are typically offered through a third party, but there's often a joint access to those keys, and this allows the institution to potentially offer other crypto products that they wouldn't be able to without that basic custodial service option. So the custodial services is really the foundation to build up your crypto strategy. Looking at trading, many of you are familiar with Vast Bank's story. They were the first FDIC insured institution in the US to offer a crypto trading platform on their bank's mobile app. This community bank success story speaks to that first mover advantage, and they did get quite a bit of press around their program, but their president had told us that their increased their customer base by 25% net new customers 8 weeks after launching their platform. Just recently, we also heard an update where they've actually grown their customer base fivefold in 80 days post-launch. We've also recently seen a few credit unions announcing that they're getting into the digital asset space in terms of offering a traditional trading platform, Again, trading is the ability to use traditional account assets to buy, sell, and hold cryptocurrency through a third-party vendor on your mobile or online banking platforms. This is done via a walled garden, so there's no issues in terms of money laundering, and it's baked right into the process. So eventually the option will be there to open up that garden and use the crypto at point of sale, like PayPal has done. The fee revenue opportunity when it comes to trading is currently being taken advantage of by those crypto exchanges, where they're charging anywhere from 100 to 300 basis points in those trades. They're also making money on the spread, on the buy and sell price, and sometimes by funding accounts. But most of it is coming through that trading revenue. So what's happening is financial institutions are beginning to see that there is an opportunity that they can be able to capture a piece of that. As you can analyze your own institution's outflows, you'll be able to see how many of your customers or members are already engaging in this activity and see how much money is flowing out, which could also be potentially affecting your lending ability. So there's room to fight also for that increased engagement with your members and customers and generating some fee income on top of it as well. When you think about this, if the average person is trading a few times a month, and trading revenue could be pretty substantial. Institutions that we've been working with, where we have analyzed their outflows, that could be your ACH, wire, debit and credit cards, we're typically seeing for every 1 billion in assets, there's about $1 million to $1.5 million per month going to these crypto exchanges, just to give you an idea. There is an opportunity, though, for these institutions to recapture some of that outflow. And maybe even if you just charged 150 to 200 basis points on those trades, that revenue could be a couple $100,000 in income or more per year for your institution. Again, you have the opportunity to keep these deposits in the institution. It increases engagement with your customers or members. And then there's other areas, as we talked about here, looking to the reward programs, lending, and so forth. So multiple surveys have showed us that about 20 to 30% of people who have investable assets are trading in crypto. So given some of those assumptions and scaling, you can see what opportunities might lie within your institution. Sorry about that. Many of the core providers on the online banking providers have been working with integrating third-party solutions for institutions through their APIs. This, again, is still not on your balance sheet. So we're hearing, and you probably have all heard a lot about NYDIG and BACT. These solutions are not the only ones out there, so your team will want to be looking at all the options before jumping into one or two of these, and we'll talk about a number of emerging third-party providers here in just a bit as well. So the strategy is going to be offering a solution to your customers that's competitive. You want something that's compelling, that's scalable enough to encourage trading with your institution as opposed to crypto exchanges or other financial institutions that may be competitors in your market. And lastly, on this slide, we are seeing more interest in crypto reward programs. The pandemic put a little bit of a damper on airline rewards and travel reward programs. Cashback has always been a big one, but with inflation, there's a little bit of a struggle with the value of what you can buy nowadays, so that bigger interest has been growing in crypto rewards. It's kind of like buying a lottery ticket, even though it's volatile. That $10 of crypto today might be worth $100 or $1,000. Obviously, with the recent dip, it could go the other direction as well. But it can be an attractive reward to offer rewards in crypto. And we know that crypto programs have launched. Recent ones that we've heard of that have tied to debit and credit cards have seen a wait list of hundreds to thousands of people and met with huge receptivity. So those are the first three areas that often financial institutions are starting with their strategies. On the next slide are the three remaining areas that are offering opportunity. The next one then is lending, and this area will evolve more as opportunities for your customers and members as they build their digital assets. So if you have the custodial services and the custody of keys, the customers or members may want to leverage their crypto for some liquidity. An example of that might be that if I had $50,000 in crypto and I wanted to pay for my kids' college tuition, but I don't want to cash it out and pay those capital gains tax. So what I might do is go to my institution and see if they would give me a loan against my crypto. The way this can happen, though, is that you can over collateralize the loan. The loan rates right now are obviously very attractive, and almost no loss is going to be associated with this because it's over collateralized to account for any daily fluctuation. So you can liquidate the underlying asset if the price moved enough that puts that loan at risk. So you can lend against it. I know a lot of institutions that will definitely be looking into this as that space grows. Some institutions are also lending to the crypto industry, which is also obviously a growing industry. Silvergate Bank did this and grew $10 billion in assets over 1 year just by lending to the crypto industry. I won't spend a lot of time in these last two areas today. Our last webinar, Larry talked quite a bit about stablecoins. Issuing stablecoins or holding stablecoin deposits could be an opportunity to generate yield. Or could be also a source for funding loans. We know the President's Working Group just published a report on stablecoins, but the need for Congress to regulate this space is also growing as well. And just real quick on the blockchain, cryptocurrency technology, this can be used, as you think about it further down the road, to speed up your settlement periods, improve security, There's P2P solutions that are out there. So as these areas continue to mature, there will be a lot of opportunity for operational efficiencies and expense reduction. But again, we'll get into that more at another time. So for most of our clients that we're talking with today, the strategy is really focused for the go-to-market in the first few areas that I mentioned on the last screen. However, just keeping in mind that long-term strategy is prudent as well. And again, we really wanted to kick off today's webinar with that most important question of what institutions are actually doing in the market. So you've seen a lot of names of institutions that have recently made announcements, and we just expect this to grow and grow throughout 2022. There will be hundreds, if not thousands, of financial institutions announcing how they're getting into the market one way or the other. So now that we've done that, we'll just take a step back on looking at adoption to understand why it's important that your teams would be discussing these risks and opportunities for your institution. So crypto is being adopted as fast, if not faster than the internet. Roughly 70 million wallets have been created. In 2020, it was actually 50 million. I also throw in this fun fact, it actually took 400 years for people to adopt the paper money when it first was introduced. So it takes some time, people get used to it, and it evolves. Even if many of you on the call today have not as actively gotten involved in crypto yet, there is an estimated 200 to 300 million users worldwide who are currently using it, and that continues to grow every day. Obviously, the asset class, 2 to 3 trillion, although again it dipped a little bit over the weekend, but it's definitely fluctuating, but likely on the trend to be $10 trillion asset class in even just a few years. So here at SRM, our crypto advisory team is seeing and hearing more and more adoption, even just from the financial institution level. Larry, Keith, and I alone are seeing just in our calendars a number, our conversations and our presentations that we're doing on a daily basis continues to climb as well. So that's why our team is growing. All right, we have a question poll out there. So as I keep talking, if you all see that, just have you go ahead and vote. Neil, I don't know if you want me to read that poll or not. I can stop for a second and have everyone take a minute to read it and answer the question.
Yeah, no, that one's pretty straightforward. We're just wondering if you represent your financial institutions, do you have a plan to roll out a crypto solution in 2022? So I know there's some answers coming in there, and we're just using them kind of more for understanding the needs of the audience here today. But Patti, I think you're good to keep going.
Okay, great. So this slide here is a chart that comes from a recent Visa survey of consumers and really their familiarity with the crypto and what services that they might be interested in. So in this particular survey, almost everyone, that 94%, has heard of cryptocurrency. 33% own crypto. That I know that might be a little bit high. Some of the other ones that we've seen have been around 20 to 25% of consumers owning crypto. 84% would be interested in crypto rewards. So that speaks to the product opportunity and offering that we talked about here just a minute ago. 81% said that they would be interested in getting into crypto linked, getting their crypto linked to debit and credit cards to use from their checking and savings account. So some movement towards that POS option. 18% are likely to switch financial institutions based on crypto services being offered. We've talked before as well, if you've joined us on some of our other webinars, about the NYDIG survey, where it showed that people who own crypto would prefer to store their keys with their trusted financial institution. And also we noted 70% said that they would switch to an institution that offered if their current institution did not. So again, speaks of the risks of not doing something in the crypto space and just how that adoption and that awareness continues to grow. So on our next slide, talking about crypto volume growing versus the rest of the space, here we see how crypto compares to other traditional financial offerings, U.S. equities, U.S. treasuries, talking about $100 trillion in industries, but crypto, as we mentioned earlier, is around 2 to 2.5 trillion in market cap. So while it's still fairly small, if you think about it, about 1 to 2% on a global scale has been done over the past few years with no help from the government or traditional institutions. It's completely community governed and basically growing on its own. But traditional institutions and hedge fund investors, as they start to get interested, will see this grow even more rapidly, which we'll see here on this next slide. So this slide, on a larger scale, the interest is increasing in crypto and the Bitcoin market and who's holding more and more Bitcoin on their balance sheets. So a lot of ETFs or exchange traded funds are getting interested. Countries, we've seen some stuff on El Salvador. There's plenty of other countries that are looking at it. We see public and private companies such as Tesla and MassMutual holding it on their balance sheets. There are also about 40 or 50 million merchants that accept some level of cryptocurrency today. And then on the next slide, in terms of venture capital, we've mentioned a lot of money going into the cryptocurrency ecosystem. Over 30 billion was invested by venture capital firms last year alone. The reason why we think this is important is because as funds flow more into it, we'll see an acceleration of that innovation and development in the space, more than even in the last 10 years has shown. So here we see 43% of crypto funding went to companies involved in trading, exchange services, investing and lending of crypto assets. 17% was directed towards startups and NFTs or non-fungible tokens, DAOs, even Web3, which is a decentralized online ecosystem based on blockchain, and the metaverse, which is a network of 3D virtual worlds. So other categories that drew significant VC interest, again, just custody, infrastructure, and decentralized finance. All of this, and as I wrap up my portion of this, is just to say that it's definitely an emerging and potentially disruptive technology. It's not going away. It's just a matter of educating, which is what we're focused on, is getting that information out, educating, understanding the risks, but also identifying the opportunities with your institution. So I'll hand it over to Keith now to talk about more of the emerging alternative vendors in the payments ecosystem. But I appreciate everybody being on and I appreciate the time. So Keith.
One of the things when you look at the current payment rails, the one thing we always talk about is embracing consumer choice. And what we don't believe is that, this is going to be the displace of Visa, MasterCard at the merchants and online merchants. But what we do believe is we're seeing a lot of momentum in different companies providing alternative sources to be able to use those crypto funds to be able to pay for goods and services. I mean, the biggest one that you saw out there was you could buy a Tesla on crypto. But what you're really starting to see is an acceleration in multiple channels. So when you look at some of these players, let's say like a Coinbase or a BitPay or Coin Payments, each one are trying to work with different institutions to bring up an ability to be able to tap into their crypto wallet, to be able to use those funds to be able to pay. And so one of the questions is, why is this accelerating? And what you saw was that the Merchant Payment Coalition just recently said that, the cost of acceptance is a little over about 2.2% at the merchant, and finding a lower cost base is one of the reasons why they may start looking to accept alternative sources for payments. And so you're also finding different interesting vendors. So as you'll have, let's say, a Coinbase Commerce or a BitPay, on the e-commerce ecosystem, you're also seeing companies like Flexa who are working with point of sale merchants and define solutions to be able to transact in that way. We think one of the big things that could really accelerate, just recently, you probably heard that PayPal is working on a stable coin. And one of the developers found it. They didn't want to announce it quite yet, but they just recently have. And when you think about it, being able to have widespread adoption, PayPal is one of those accelerators that could truly take it to that next level. There's a lot of pros and cons here. Some of the pros and why somebody would want to use this would be, when you're thinking about a lot of people view it's more secure than a central hub where it could be breached, and it settles on the blockchain. And so that way, making it very difficult to steal somebody's identity. A lot of people like the fact that it's irreversible, so no chargeback, so lower cost in the back office, also lower fees, but there are some cons, to be able to think about. Back office, things like refunds can be more difficult. Settlement times can be a little bit longer. And the big one is IRS consideration on cryptocurrency is property. So when you buy and sell transactions, it's at the value at that time. So with the volatility, let's say if you're buying it for $100, but then later on it's worth $80, you're paying tax on that $100. So there's a lot of pros and cons that go with that. So when you go into the next slide, when we talk about regulation, the interesting thing we've seen is the next big question we really get is, how are the OCC from a bank perspective and from a credit union perspective thinking about it? So when you look at the OCC, they had an interpretive letter, the 1179, that basically set the stage of you need to ask permission versus forgiveness. And so what they're saying is that to go into it, one of the key elements of regulation is to notify the supervisory office that you intend to engage in these activities. The second component would be they're going to be looking, like they do in many of your operations, looking at your operational risk, your strategic risk, your liquidity, your compliance, understanding of a lot of the different obligations, and then to be able to grant you a non-objection, which then basically says you're allowed to provide, custody of crypto assets and hold dollar deposits as stable coins. On the other side, there's a lot of concern with, what happens if I've gone into it and I didn't ask for permission. And so they're pretty specific in saying you don't need retroactive approval, but you're going to be held to the same scrutiny as they did with ones that are asking to move into it. When you look at the credit union space with the NCUA, just late last year, they did provide an announcement and guidance, basically saying that it didn't prohibit, which is a little less enthusiastic in saying that you're allowed. But it basically said that it went on to list of the factors of saying you need to exercise things like sound judgment, conduct necessary due diligence activities, risk assessment, planning. So a lot of it is just basically making sure that a lot of the due diligence is in place. But what they did make sure that credit unions knew was a federally insured credit unions, that the insured part, that the federal government was not going to be insuring those crypto assets, that the third-party provider that would be holding it, if you're looking for insurance, that would have to be provided by that third-party provider. So when you go into the next slide, when you think about central bank digital currencies, there's so much activity that's been going on around that. And there's been a lot of recent announcements. This is there's a lot that's on this slide. I'm going to unpack about 3 things. I'm going to talk about the Fed. I'm going to talk about the White House announcement. I'm going to talk about China. So when you're looking at the Fed basically, there was a lot of anticipation about the Fed coming out with a paper and guidance. And while it weighed in on it, it really didn't offer clear signal and no policy recommendations. Basically, the Fed said, without clear support from the executive branch and Congress, ideally in the form of support specific authorizing law, while it's going to continue to look at the benefits of it, they're looking for other branches to move more definitively as it looks to move forward. So what in part of the paper, they talked about some benefits, such as central bank digital currencies offer a lot of benefits, like, the digital money is free from credit and liquidity risks. And it also reduces a lot of common barriers when you're thinking about financial inclusion, lower transaction costs, helping low income and underbanked individuals. And it also thought a lot about how it could streamline cross-border payments using this new technology. And essentially what it doesn't want to do is it doesn't want to get in the way of innovation, but it also wants to be very thoughtful because there's a lot of considerations. And unlike China, who was one of the first adopters, they wanted to think about the alternatives and thinking about questions like, how does it alter the role and responsibilities of the private sector versus central bank? How does altering the supply of the reserves in the banking system affect monetary policy implementation? And also that what they want to do is strike the balance between the right safeguards and consumer privacy versus transparency necessary to deter criminal activity. And the interesting part when you think about it, that in just the nature of the US economy is just very skeptical about government intervention and being able to see that level of detail, especially what's available on the blockchain. So basically what they did is they're going to ask for more feedback, and you'll see at the bottom, there's a link. And what they're doing is collecting feedback from the public to do further analysis. Just recently, though, the White House, the Biden administration also put together, and announced that they're going to be coming out in February with an executive order around cryptocurrency. So what do we think that's going to address? We think it's going to address the economic, regulatory, and national security challenges posed by this central bank digital currency. What they did say is they want to play a key role in overseeing the policies and regulate it. And what we anticipate them doing is to be able to ask other federal agencies to evaluate the risks, such as the Department of Commerce being tasked to look at the country remaining a leader in the digital asset space, while the State Department may think about how we might use it as a more diplomatic opportunity for the sector. Basically, what they're looking for is a very broad, transparent public dialogue. They want us to be a leading provider, but also a very thoughtful provider. So the interesting part when I wrap up this, the third leg of it is China. China has been looking at this since about 2014. And what we're seeing is they're officially rolling out this digital bank currency at the Olympics. And that was the big announcement that they're going to be rolling it out where the Olympics is only going to accept cash, renminbi, Visa, and the digital yen. And so what was interesting is they were going to roll it out at the Olympics, but what they decided to do was roll it out a month ago in a pilot format. Since then, we've seen 260 million individuals upload their digital wallets, and we've also been seeing that they're transacting on it. So since it's been rolled out, we've been seeing about 14 million worth of transactions going through. But when you compare that to the about 1.3 billion users of Alipay, and Alipay doing about $17 trillion worth of transactions, you can see it's a 0.1%. So I would say the success of it is still to be determined, but what they're trying to do is take a predominant role in the central bank digital currency, and this is going to be the big rollout. So when you look at how many banks or how many countries have rolled it out, so far 9 countries have rolled out central bank digital currencies. You have 16 which are developing one coming up, 14 are in pilot stages, and 41 are still in the research phase. And that includes the US. So there's still a lot to unfold here. But what we would do is encourage you as participants taking a look at the guidance that they're seeking and weigh in on and how you think it could impact your success as a financial institution and what you like to see the government intervention and involvement. Right. Larry, to you.
Yeah, great job, Keith and Patti. Thanks so much. So just to kind of extend on what Keith was saying, crypto has remained, fortunately, a fairly nonpartisan issue, with 60% of voters actually supporting cryptocurrency and seeing it as something that the U.S. needs to remain supportive of to remain financially innovative on the world stage. So there's that piece of it. In terms of stable coins, and stable coins are used a lot on the crypto exchanges to kind of get in and out of positions quickly, but it's very quickly being adopted by financial institutions. We've seen a number of banks start to implement it for instant real-time settlement with either other institutional investors or other financial institutions. And what a lot of people don't realize and why there was a focus this year on stable coins, and Keith mentioned earlier, the President's Working Group, which came out with some recommendations November 1st, is that stable coins settled this last year about $6 trillion of value. For comparison, Visa globally settled about 11 trillion in value. So pretty significant amount of money movement with stable coins. And so President's Working Group saw that as kind of a potential threat to the dollar's world dominance. I think at the end of the day, they realized that stable coins are backed by US dollars, US treasuries, and other sorts of kind of short-term financial instruments. But there is an opportunity, and I think a lot of politicians are realizing there's an opportunity for stable coins to kind of continue to support the role of the dollar around the world. The President's Working Group consisted of US Treasury, Federal Reserve, SEC, Commodity Future Trading Commission. I think the OCC was involved as well. NCUA was not, but there's been a lot of discussion afterwards. The recommendations were for Congress to basically come out with guidance around this, and they gave some recommendations to Congress. Now, whether or not Congress is going to make any sort of changes as it relates to stable coins in the near term, highly unlikely, just given the makeup of Congress. But the stable coin issuers have not stood by idly, and a lot of them are trying to address some of the concerns from President's Working Group, which they knew were going to come up. A number of them already pursued getting their own banking licenses, charters, or partnering with financial institutions. So the takeaway here is whether that regulatory guidance comes from Congress or not, this just kind of general focus on regulation is going to add legitimacy and further adoption of stablecoins and other cryptocurrencies. Neil, can we advance? Yep. So in terms of the specific recommendations, a couple key pieces here is that they only want stable coins to be issued from insured depository institutions. Now that's interesting that they assumed, because I had assumed assured depository institutions would be the FDIC insured, but I think it also would include the NCUA with their share insurance fund. But what's interesting about it is if you think about stablecoins are supposed to be backed one for one. The reason we have obviously insured depository institutions is that, for fractional reserve banking, we don't have, deposits to match all of the kind of loans that are out there. So we have that insurance to prevent kind of a run on the bank. Well, with stable coins, they're backed one for one. So I suspect the President's Working Group is kind of thinking ahead in that, stable coins, being that they are stable, that they do have underlying assets. I think they are concerned that they might provide some sort of competition to existing deposits. And if there was a run on the bank, the people might go to stable coins. So the idea of that they would have to be with insured depository institutions also might lead to possible rehypothecation of those underlying assets. So I think we could ultimately see those stable coins freed back up for kind of re-lending, but time will tell. But at a minimum, what they wanted to do was have those deposits held at, again, financial and insured deposit institutions. In terms of addressing payment system risk, the key takeaway here was that custodial wallet providers would be subject to appropriate federal oversight. They're not today, although a lot of them are abiding by kind of standard know your customer and AML type of rules. But I think they want to see additional oversight. And then kind of the last one that I found interesting was it addressed systematic risk and concentration of economic power. And I think this was pretty much focused towards Facebook and now Meta in their DM project, which was previously called Libra, but it said that would require stablecoin issuers to comply with activity restrictions that limit affiliation with commercial entities. Libra and DM were Facebook's project and launching kind of a stable coin. Now they've moved away from that somewhat. And I think they've got some trials with, I want to say Circle or Paxos for international remittances. But DM does seem to be apparently on the back burner in the head of Facebook's efforts there, actually left the company. So more to come around that, but we will see some recommendations, I imagine, come from Congress in the coming years. Neil, if we can advance. So we did see one regulatory piece come out of Congress this year, and it's around the Infrastructure and Jobs Act. And what was interesting about this one was there was a lot of debate in terms of this little previously known crypto provision around kind of definition of who would be a broker. And that language was pretty broad. The language apparently came from U.S. Treasury via some senators, but at any rate, it would subject kind of brokers to the same sort of reporting requirements as kind of other financial institutions have. And you would have to file an IRS form 1099B for these technology providers. And those brokers, what they claimed were brokers would be proof of stake validators and proof of work miners, which really don't have any sort of view into the individual transactions. And so they wouldn't be able, a lot of these couldn't report on this tax form anyway. Blockchain node operators, software developers, crypto wallets, suppliers. So again, I think there's going to be a move to amend this language or correct this language and make it a little less broad, but that did end up getting passed, was effective back in November of last year. Now, those broker definitions won't actually come into effect in January of 2023 with the needed reporting requirement in 2024. So there's a number of years for the crypto industry to kind of help legislators correct that language. The good news was the crypto industry really came together, kind of got their act together as it related to lobbying. And now a lot of our Congress members have a much better understanding of kind of risks and opportunities as it relates to cryptocurrencies and stable coins and other sorts of digital assets. So at the end of the day, I think having gone through that effort was probably a good thing. I don't know at the end of the day whether or not it'll stick, but it is what it is. Neil, next slide. So the big why would you as a financial institution might be interested in getting into digital assets? What we're seeing from most of the clients that we talk to is they're seeing a lot of their deposits flow out through ACH wire, debit, credit, et cetera, to the crypto exchanges. And the crypto exchanges, people are buying obviously crypto on, and the crypto exchanges are making a lot of fee income on that. So the average fee in the U.S. right now is about 233 basis points to 0.3%. Range anywhere from 1% to 3% for most retail trades, although it can be much lower, particularly as you trade larger amounts. So it does have some tiered pricing, but again, average is around 2.5%. So if a financial institution was to provide kind of digital asset solutions like the exchanges do, then they obviously could have an opportunity of gaining that trading revenue. And that trading revenue is billions of dollars. All you need to do is look at a Coinbase annual report to see how much that could possibly be. Most of our institutions are seeing fairly large outflows go into the exchanges, somewhere along the lines of about $1 million of outflow per month per about $1.5 billion of assets. So you just look at how big your institution is, might give you a rough idea of what you might be seeing from an outflow standpoint. There's about 75 crypto exchanges in the U.S. So knowing what they are and what to look for is pretty important. PayPal, Robinhood, Square, all of them have crypto trading divisions. In fact, Robinhood makes about 50% of their trading revenue on trading crypto. So if you're seeing outflows to some of those, it's a good chance that a lot of those outflows might be related to customers or members purchasing crypto. So there's an opportunity to defend your source of funding. Deposits, obviously, fee income would be non-interest income. There's an opportunity to drive that. Patti talked earlier about lending to the crypto industry as well as lending against crypto assets. And so there's an opportunity there to drive 700-800 basis points of lending revenue, interest revenue with little to no losses because it's over collateralized loan. There is an opportunity to gain clients in market share. I know when PayPal kind of first got into cryptocurrency on their app, they saw about 14.5 million net new customers the following quarter that they announced that they were going to have a crypto trading app. Vast Bank, which I think I sent a note to number you on the chat, Fast Bank saw a 5-fold increase in their client base in the case of 80 days post-launch. So there really is an untapped need out there in the marketplace for financial institutions to provide these sorts of solutions. And what we've seen is fintech providers and crypto exchanges provide those services. And again, at the expense of traditional finance. There's also an opportunity to increase client engagement in terms of a lot of these implementations are through the kind of, a digital app. That app, if you think about your mobile banking app and the number of times your clients might be looking at that on a daily business basis, if you had crypto on there because of volatility in prices and the interest from the general public, you'd see probably a 2x or larger increase in looking at that app on a daily basis. And that's obviously an opportunity to educate those clients and to cross-sell other sorts of products and services. And then the last one here is really to avoid being disintermediated and decentralized finance. We didn't go into a lot of, we've talked about it on previous presentations, but this is kind of peer-to-peer lending, and it's grown to about $100 billion business. But this is using software to kind of connect borrowers and lenders and offer bank-like solutions, and that's pretty significant. What I want to say here too is that we're seeing a lot of interest in this. We're talking to 4 or 5 clients a day about getting into kind of crypto solutions into the market. NYDIG, which is one of the service providers out there, there's probably about 2 dozen of them. NYDIG and Bakkt are the most similar in that they provide kind of a fairly simple way of getting into cryptocurrency. They estimate, actually, this is from a report from American Banker, that about 300 community banks would start offering Bitcoin only trading on their mobile apps in the first or second quarter of this year. I think NYDIG has publicly said about 1,000 are going to come to market in this year alone. I mentioned there are other similar solutions like Bakkt. Most of these solutions are being provided via their bank, mobile banking service providers. So partnerships with Alchemy, Q2, Digital Insights, and it makes for fairly easy rollout. I would just caution that easy doesn't always mean right. Our concern is a lot of these initial solutions being limited only to Bitcoin or in the case of Bakkt, Bitcoin and Ethereum only, might not be competitive enough to win back business from the crypto exchanges. So kind of like implementations of Zelle after PayPal and Venmo already cornered the market. You might be paying a fair amount of cost and or revenue share for something that you might not get as much of a lift. So what we're cautioning our clients and just the general market to do is to really think through what that solution should look like. And is it going to be something that's going to be competitive with the fintech providers or crypto exchanges out there, and really win back some of those deposit outflows. The other concern is if you implement a Bitcoin only solution, and Bitcoin's a great cryptocurrency, it's the top one out there. It's a market cap about 700-800 billion, and probably the most popular. But one of the things to think about, crypto exchanges make about 50% of their revenue by trading all the other cryptocurrencies outside of Bitcoin. So if you do Bitcoin only, you're going to miss half of the revenue. In addition, if you do Bitcoin only, what you might do is encourage some of your clients that aren't involved in cryptocurrency today to start trading with your financial institution, which would be good to generate some trading revenue. But what happens when they discover other cryptocurrencies and they say, hey, we want to try getting invested in Solana or Cardano or one of the many other 5,000 that are out there? You may end up pushing those clients to the exchanges because they don't have the option of trading more than just Bitcoin only on your platform. So there are a lot of great solution providers out there, and we would definitely encourage people to kind of think that through. Neil, can you advance the slide? In terms of getting to market, if you do want to go to market, I mean, obviously strategic resource management and our consulting firm is happy to help you with that, but these would be considerations. And this is kind of the go-to-market strategy we've come up with, and we're helping clients with this today. First is really to understand the opportunity and risks, and that means doing those outflow analysis. That only tells you what your current clients are doing. It doesn't really tell you if they're funding those crypto trades through another financial institution. So we also suggest doing employee member customer surveys and focus groups to get a better feel for, are they trading using another source of funds, and how many planning on trading crypto in the near future? So if it's 20%, 30% today, and we expect another 20% to do it before the end of the year, you could be talking about 50% of your clients suddenly being interested in trading crypto. You better have a solution. We do a fair amount of education at the board, executive level, as well as for employees and clients. We help build kind of competitive analysis of all of the different solutions that are out there in marketplace today. Help you understand the use cases. Again, custodial services, trading, lending, stable coins, and other sort of kind of digital ledger technology solutions, even including staking. And then we also have we've started it back up this year. A number of you probably already have invites for it, but we do a bi-monthly crypto university. It's an hour kind of chat session with people from the industry. Often we'll have special guest speakers, but we'll talk about just kind of open forum about what's going on with digital currencies and how that's impacting the financial market. We also develop, obviously, understanding the opportunity is one piece of it, but developing a strategy is something else. So again, hitting the equivalent of that Staples Easy button and going with a solution that's just quick to roll out may not necessarily be the right solution. So, we think about infrastructure readiness. We help you kind of look at your current infrastructure relative to what, a crypto provider might need, build that gap analysis, strategy development, a lot of design management conversations. We do a lot of thought and talk and discussion around compliance and risk to help you build out that strategy. And also so it fits with your kind of broader digital or just financial strategy. And then, of course, once you know what kind of products you want to get to market and what they might look like, is picking the right partners to help you do that. We are very well kind of astute in terms of vendor selection and how do you implement these things. We build out RFPs, and in RFPs, some of the things to think about would be around, product questions, customer support questions, governance and compliance. Are these vendors SOC 1, SOC 2 compliant? Security, do they have a multi-sig, do they have hot, cold wallet, warm wallet solutions, IP address, say IP address, whitelisting and other sorts of things. Some of it would be around insurance considerations because this stuff is not FDIC or share insurance insured. You want to be able to protect those clients from any sort of fraud, losses kind of due to fraud or criminality, in which case, you can get third-party insurance. Sometimes some of the exchanges or liquidity providers provide that as well. Making sure that the partners have the relevant licensing. So they may say, well, we've got a Department of New York State Financial Services BIT license. Well, that's great, but it's really only applicable in New York State, and in which means they might probably just have a money transfer license in all the other ones. And well, is that better or not as good as maybe a company that is a trust company, has some more kind of licensing considerations. Obviously, also talk a lot about integration. We make sure that integration, most of those integrations are through APIs. The technology lift to get to market with the solution is not really that difficult. What's difficult is making sure that the solution to bring to market is going to be competitive, it's going to be scalable, is going to be something that your clients are going to ultimately want and grow into. And then all of the other solutions that you might not be thinking about today, but are going to come down the pike, and we help you think those things through. So if you run out with an early kind of easy solution, you might pigeonhole yourself into something that is not that flexible in terms of, as the crypto industry and digital asset industry grows. We didn't talk a lot about non-fungible tokens, but that's becoming a bigger piece of the crypto ecosystem, and a lot of these other partners aren't even considering that. And then in terms of rollout, how do you market it? How do you price it? Do you want to price it to be competitive with other financial institutions, with fintechs, with the crypto exchanges? I would say all three. What are the right disclosures? Disclosures are really important with this stuff. No one can give kind of financial advice around cryptocurrencies, but you can provide educational advice. And then from a tracking compliance standpoint, what are the things you need to think about? Again, kind of pretty quickly, just kind of 4 key areas in terms of getting to market. Hopefully that was helpful. Want to thank everyone today. I know we're coming up on the 12 o'clock hour here for your East Coast time, but want to see if there's any additional questions to follow up. So with that, I'm going to turn it back to Neil and appreciate everyone's time today.
Yeah, thank you, Larry. And if there are any other last minute questions, please do feel free to drop them in the Q&A. A couple things that maybe we can cover off on, Larry, or Keith or Patty, if you guys want to jump in. One of the questions that we saw here, of all the banks and credit unions that you've seen adopt crypto solutions, I know, Larry, you've been tracking this. Is there one that stands out as sort of the most impressive that's really planning best for both the near term and the long term?
Yeah, I would say it's that Vast Bank, without doubt. And a number of, we're going to see a lot of solutions come to market, some of them better thought out than others. But Vast Bank did a very nice job. I think they came out initially with 8 trading pairs. Now they're up to about a dozen. And going back to my comment about, half of the revenue that crypto exchanges is derived from non-Bitcoin trading, it's important to have other sorts of coins or currency that your customers or clients or members can trade. And so that's something worth thinking through. The big concern around some of that is what ones aren't securities. I can tell you, some of the providers out there make a big deal about that because they say, well, Bitcoin's only one that definitively we know is not a security. Well, that may or may not actually be true. There's a lot of lawyers out there that have looked at those cryptocurrencies to see which ones are or aren't securities. I'll give you an example. Coinbase, anything that they've listed on their exchange, they got probably a few hundred coins. They don't consider any of those securities. Now, like, XRP is one that's currently in a lawsuit, Ripple through with the SEC. That one is not listed on Coinbase, and for that reason. But I say that being that if Coinbase can list a couple hundred and Vast can list a dozen of them or so, you certainly should have the opportunity to list more than just Bitcoin or Ethereum and pick up on maybe some more trading revenue. So again, the easy solution isn't always the right solution.
Yeah, that's definitely helpful. And thanks for giving us a good example of that. And one other question that came up, and Keith, I think you've been tracking this, so maybe you'd be interested in taking this one, but I'll put it out to the group here. Is any kind of additional thoughts on how this crypto reward space could expand, or do you foresee bigger partnerships or cross-commerce scenarios, anything that sort of stands out in terms of predictions around the rewards piece?
Yeah, I would tell you right now, with all the rewards players, everybody is looking at adding it into their stable. And the one common denominator that they're seeing is being able to attract 2 things. One being a younger generation that has typically been using a Venmo, real-time payment, and a debit, moving them more into the credit space and using that as a hook. The other thing is where you have one clientele which may want a 2% or 1.5% that they know they're going to get it. There's another group of individuals that know there's a big upside for crypto. So they view it less about it as a tangible asset and more about the ability to be almost like a gamble, to be able to say the opportunity to get more. So what a lot of institutions are finding is it's a very good attractor for new customers and diversified customers in spending their accounts. So I think that that's going to be the biggest trend that you're probably going to see. And again, to Larry's point, the big question is going to be for institutions, who are you partnering with? And when you're thinking about the custody and compliance, there's a lot of questions that will come up in who's the right partner. And that's really what we've been doing, is spending a lot of time talking to each of the partners, understanding the value equations to help take a lot of the noise that's out there in the industry and really simplify it. And after a conversation, really help connect you with some partners that might be the best fit for your institution to think about it.
Yeah, that's a great endpoint. And I know Larry has done a lot of tracking around that and even mentioned that earlier, making that point around kind of the selection of the partner and thinking about kind of the true pros and cons and going with the kind of the easy choice versus something that's a little bit more bespoke for your specific needs. So something we're certainly going to continue to track. I think maybe the last question that came up here, and again, I'll open it up to our group of panelists here from SRM. Is there any other predictions in terms of bank and credit union adoption of a crypto solution in 2022 that you're seeing and that you're kind of foreseeing? I know there's been some additional numbers that have come in around that in recent days. So just wanted to kind of throw that out there as more of kind of a broad one to finish out our talk here today.
Yeah, I know Larry and I have been talking about this. I'll make it real short and pass it to Larry. I think 2 things you're really going to start to see explode. One is NFTs and being not as much trading digital pictures, but more about digital titling and fractional share ownership. We really think that there's going to be a lot of momentum there. Also, a lot of decentralized finance. I think you're going to see a lot of momentum there. And Larry, what are your couple thoughts?
Yeah, totally agree with that. I mean, we're obviously going to see more implementations. I think in the credit union space, we're going to see Kusos to start to also provide some solutions out there. The crypto exchange providers, liquidity providers, custodial service solution providers, security solutions, all of those have been really focused on kind of large institutional investors, working with some of the very largest banks, venture capital firms, but they are very much interested in getting into traditional finance and providing solutions to the market. And so we're going to see a lot of other solutions come to market. There's been a couple of providers have done a very good job of marketing and getting out there early, saying, "Hey, we are providing a way of trading crypto for your clients." But there's a lot of other better and great solution providers out there. And what I would say is look at your vendors and see if they're really utilizing their own technology and their own solutions, or are they just white labeling someone else and taking a fee as a percent of that? Because I suspect it's the latter. And again, so sometimes for some folks, and again, I'm not suggesting one way is the right way or not, but for some folks, maybe building that more bespoke approach or solution might provide them with a better product and one that's going to drive more revenue for the institution. Patti, did you want to jump in?
Yeah, I agree with both of what you guys said. I think that we'll see a lot of those headlines saying that there's institutions that are, I saw one this morning said it was the first credit union, and it's actually not the first credit union to offer the NYDIG product. So you'll see a lot of headlines that say institutions are offering cryptocurrency, but when you read into it a little bit, you find out it might just be the NYDIG solution, just Bitcoin. And as Larry said, there are other options and other vendors that give you more that you can offer to your customers or to your members. So it's like with any headline, just reading into the details a little bit and knowing that we'll just see a lot in the headlines, but digging down into the weeds a little bit, there are more providers and there are more options.
Yeah, and if I can just add, NYDIG and Bakkt, and there's a lot of providers out there. They do a very good job. They're early to the market. Super impressed with their offerings. So again, not saying that those are not the right solution for a particular financial institution. But what will be interesting is there's been a lot of headlines out there about partnerships and new launches. What will be interesting is do we see headlines similar to this coming out of Vast Bank, where they're talking about fivefold increase in their client base, or how much adoption they're getting, or fee revenues that they're seeing, and those sorts of things? Or will it be kind of we've got the solution, but we really aren't seeing the kind of lift we were expecting? And again, I think we're going to see more of the latter, that may not see the lift. Again, it's got to be competitive with exchanges, and if you're not providing something outside of that custody, why would someone want to trade with you rather than an exchange? And that's a big question. But do appreciate everyone's questions today. And Neil, any last minute words you want to wrap this up with?
No, I think we're looking good. Appreciate everybody attending today. We do hope it was educational and insightful. Please keep an eye out for more upcoming program here in 2022, which is coincidentally SRM's 30th year in business. So we're excited about that. And look for a follow-up email with a recording of today's webinar, as I mentioned at the beginning. And please do reach out to Larry or Patti or Keith or your SRM contact if you want to talk more about your plans and your needs in the crypto space. We certainly want to be able to help wherever we can. So otherwise, take care, and we look forward to having you all join us again. So thanks so much.
Thanks, everyone.